You can turn me on. I'm on. Good morning, everyone. My name is Jeff Bruss. I work for Cole Publishing. We publish the Pumper and Cleaner magazines and a whole bunch of other ones, and we obviously put on this show as well. One of the most common questions we get, I've worked for Cole Publishing for almost 14 years, and over those 14 years, one of the most common things we were always hearing on the telephone was, I'm looking at selling my business, what is it worth? And for 14 years, we always tried to direct people to someone else. Even though we heard a lot about businesses and understood how they worked and everything like that, we never really wanted to answer the big what's it worth question, nor did we ever really want to represent them in a sale or anything like that. But as the economy turned sour over the last couple of years, we started to get even more questions asking what's my business worth, if anything, and we decided to put on another hat and start to more or less just help people in the industry determine what their businesses are worth and how you go about buying or selling a business in the septic or sewer industry. And we've been doing this now for about 18 months, and we've learned a lot, especially me. So what I did here is I put together about a half-hour, 45-minute session on the basics of buying and selling a septic or sewer company. I'm depending on all of you to be somewhat interactive during this session. I expect you to ask questions and encourage you to ask questions. And I know nobody likes to speak up in a situation like this, but I can assure you, if you're in this room, you all have the same questions, so there is no such thing as a stupid question. So anyway, we'll get started. The very first thing I always ask somebody when they're selling their septic or sewer business is, why are you selling? And the reason I ask that is because the potential buyers are going to ask the same thing. There has to be a reason, no matter what that reason is. The number one reason I usually hear is retirement. A retirement sale is completely acceptable, obviously. The other reason is there's nobody to pass it down to. Sometimes the reason is it's just too much work. But make sure that you're determining a reason on why you're selling your business to begin with. If you have no valid reason, the reason most often is because they think you're going to go out of business anyway, and that's certainly not the perception you want to a prospective buyer. So determine your reason on why you're selling it. The other question I get, the second question is always, how much time is it going to take to sell? I'm going to be honest with you, almost all of them never sell. And we're going to get into the whys on that later, and if you can address those whys early on, you won't be one of those businesses that never sell. The majority of them never sell. Some of them take more than a year to sell. In fact, the majority of them that do sell will take more than a year to sell. What we're going to get into is start thinking about selling long before you are, otherwise it won't happen. When a business doesn't sell, it doesn't mean that the assets don't sell, doesn't mean that the real estate doesn't sell, doesn't mean that your customer list may not sell, but that's not the reason why you want to sell. You usually want to keep it as a whole. It's always more valuable. If you sell your customer list, you might be lucky to get, $5,000 for a couple thousand names in a database. You might be able to liquidate your assets for the auction value, but you aren't going to get what you're going to get if you keep it as a whole. Real estate is another thing that's iffy. A lot of times, depending on the buyer, they may not want real estate. Most times I try to talk sellers I try to tell them to remove the real estate, price it as a business only, and make the real estate an add-on. So you could say, well, we want $100,000 for the septic business, and we have property worth another $100,000 if you want it. The reason businesses oftentimes never sell is, number one, poor record keeping. Everybody in here is always trying to hide money from the IRS. If you want to sell your business, I'd suggest that today is the day you stop hiding money from the IRS. And I'll show you some reasons why later on in dollars and cents on why you're going to lose in the end. If you're not planning on selling your business today, continue to hide it. The other reason is there's no barrier to entry. A lot of people the number one thing people always think is their business is worth more than it is. If you're just, I say just, if you're running 1 or 2 trucks, 3 trucks, there's nothing to stop somebody who's never pumped a septic or ran a drain cleaning business coming into this show, buying 100 portable toilets and a septic truck and going into business tomorrow. They create a website, they make a yellow page ad, and now they're pumping septics. You need to keep that in mind when you're pricing your business. So those are the types of things where you provide better service, you show great revenue, you take an owner's draw, you do all of those things correctly, and your business will be worth more in the end, and it keeps out those people who have no barrier to entry. We're going to get into financing as well. Number one thing that I'm dealing with right now, I have a lot of buyers who have no money and a lot of banks that don't want to give it out. When you get ready to sell, we talked about, or I touched on, that you have to quit hiding money from the IRS. Almost without fail, every business I've ever shown will send me a balance sheet or a profit and loss statement or their income tax return, and it's showing no profit. If you show no profit or little profit, how do you expect the person buying your business to make the payment? They can't. So every dollar that you earn should be recorded in your books. Money that isn't on the books does not exist in a sale. I don't care how much cash you make or how much cash you tell me you make, the buyer doesn't care. So if you're not recording that dollar, I do not appraise it when I appraise the business for sale, and we don't add it into the asking price, and the buyer's not willing to pay for it. Maintain a minimum of 3 years of qualified books. When I say qualified books, what I'm talking about is not hiding any money. And realize that you don't have to hide the money. Granted, you're going to have to pay income tax on it, but take an owner's draw. Just show a profit. Any of those things are what I'm saying, just show it on the books. We need 3 years minimum for any buyer. We usually do a 3-year average gross, and that's how I appraise, and I'll get into that. So I would need 3 years of profit and loss statements or income statements, balance sheets, things like that. I already touched on take an owner's draw or a salary, somehow pay yourself. The buyers are going to want to see everything about your business. You aren't going to be able to hide any of it. I'm going to ask you for all of it. It's going to be prepared in advance. You have to be willing to show all that. The one thing we do is we ask every potential buyer for a non-disclosure agreement. So some people may be worried about, well, my competitor's just going to be nosy and he's going to want to see my books. The way we get around that is we ask for the non-disclosure agreement. We go to the buyer and say, here's the potential, we go to the seller and we say, here's the potential buyer. Is this someone you want to share books with? You have it available to you to say no. But realize that usually your competitor is your best bet at being your buyer as well. So you're probably going to have to get used to sharing some of that information. Make sure you document your personal and non-operational expenses. If you're writing off your internet service at home, if you're driving a company pickup truck, if you're doing a lot with entertainment, all that money you're spending down here, even though it looks like a business expense, we know that that's those expenses that kind of turn into the gray area. If you can show that those aren't necessarily expenses, they could have been profit, that's going to be more substantial. That's going to make the sale look more substantial in the end. You're going to look like you're worth more. So all those little fringe benefits you're taking, if you know you want to sell in 3 years, quit taking them now. Turn those into profit. Make them look like a profit on the books. Here's my favorite one to talk about. Every time I get someone on the phone and I say, what's your equipment look like? They say, oh, it's fantastic. It's near mint. And I say, what is it? And they say, well, I've got the best looking 1989 pumper truck you've ever seen. And I say, well, it might be the best looking 1989 pumper truck I've ever seen. What do you think it's worth? He said, it's a 4,000 gallon tank. It's pristine. We always park it inside. It's got to be worth $85,000. And I say, you're right on. You can put it in the back of pumper and we'll see how quick it sells. I'll appraise equipment at a wholesale level. And when I say a wholesale, that means auction. If we want to use real numbers, let's say we've got a 2006 unit that might be worth $85,000 for sale used in a back of pumper. The wholesale value on that truck is probably closer to 55 or 60. You can take an easy 25% right off the top. That's what your equipment is going to be worth in a sale. Equipment that hasn't been maintained or isn't operational, if you have a backup truck, it's not part of the sale. Any piece of equipment that doesn't make money is not part of a sale. It has no value. So a backup truck, equipment that gets used once a year, the only equipment that you can appraise as part of a business that a buyer is going to be interested in is equipment that's out making money. And obviously your equipment is not as valuable to the buyer. Especially if you've got a competitor that's buying you out. If they have idle equipment, there's a great possibility that your equipment will have no value to them, none at all. So in that case, what you can do is you can sell the business and the equipment separate, but you do need to keep that in mind, that your equipment has less value than you think it does and that your buyer may not be interested in it at all. Your customer list. I represented a business in Minnesota for almost a year, and we got with the buyer. He had one 1979 pump truck, and he had 2,000 customers on 3x5 note cards. This is a true story. This happened this year. If your database is on 3x5 note cards, it has no value. It has to be on a computer, and it has to be a computer from this decade, preferably one from this year, because your potential buyer is probably going to want to see those customers. They aren't going to want to see who they are necessarily, but they're probably going to want to report on the revenue that they generate from you, especially if those are contracted customers. Put them in a computer. Contract as many customers as you can. Contracts essentially go right to the bottom line when you go to sell your business. If you have a contract to pump 20 grease traps at Arby's in your area, and that generates $20,000 a year in revenue, I can almost dollar for dollar add that to your asking price. So consider your contracts and try and get as many people on contract as you can before you think about selling. And now we're going to get into pricing. This is the fun part. Every business has a different worth. It depends on your location. It depends on how long you've been in business. It depends on how much equipment you have. A lot of it depends on geography. And it also depends, again, on what you're showing on your profit and loss statement, what you're reporting to the IRS. And the way I determine that is based on a lot of it's hunch. Some of it's what we hear from other people. If you're calling me from Wisconsin, I've probably appraised 12 or 15 businesses in Wisconsin. I know if they have declining revenue or increasing revenue. If you're calling from me from Michigan, I've done a half dozen there. So we just call on what we've already known and appraised. There are certain areas of the country that are doing really well. Texas. There's some others that aren't doing so well. So we take geography into consideration. When you take geography into consideration, we're from 3 Lakes, Wisconsin. In 3 Lakes, Wisconsin, there's one septic pumper who I can't talk about because he's actually sitting in the room, so that makes me a little bit nervous. But he's the only guy in 3 Lakes, Wisconsin. If you're from Milwaukee, Wisconsin, and you can serve 10 million people, that's a lot different than if you're from 3 Lakes, Wisconsin, where you serve in that city 2,000 people. But the other thing that's different is the proximity of those routes. The guy who's in 3 Lakes, Wisconsin might have to drive 20 miles between routes. The guy who's in Milwaukee, Wisconsin can maybe drive to a cluster system and potentially pump 10 systems in the same amount of time a guy in 3 Lakes, Wisconsin can pump 3. So you're hauling more volume. So when you're appraising a business, you're taking geography into consideration on a huge level. There's kind of a rule of thumb that I use when I appraise a septic business. If you're in a small town and you're doing $100,000, $125,000, $150,000 per truck, that's where you should be. You're probably doing your business correctly. If you're in a bigger metropolitan area, you should be able to pull $250,000 per truck. You're doing everything right if you're doing that. That's all things equal. Businesses with greater tenure. Actually, let me pause. I'm a fast talker. If I'm talking too fast, people need to tell me to slow down. First question.
What do you consider a small town?
Damn. The question was, what do you consider a small town? I'd say population less than 50,000. But again, it depends on a lot of things. If you were to send me details, I could just how many gallons you're bringing to a treatment plant or something like that. But I'd say generally speaking, less than 50,000 with no real population around that. You know what I mean? An isolated 50,000. 3 Lakes, Wisconsin is definitely small. The question was, what was the value per truck you should be making if you're doing everything right? And again, this is a huge generalization, and I'll get into this in a second, and it'll be a little more clear. A huge generalization is if you're in a relatively rural area, you should be able to pull about $125,000, $150,000 per truck.
Rural meaning?
Gross, correct.
Rural meaning what?
Less than 50,000. Okay. If you're in an area with a higher population, again, this is rough. You should be able to pull about $250,000 a truck, $200,000, $250,000 a truck. Chances are, though, you guys might be operating at the same profit level because your cost of labor is probably higher, your disposal costs are most likely higher, things of that nature. So don't think if you live somewhere that's not very populated right now, you should be moving to the population. in the back. The question was, if you have 6,000 customers and roughly 1/3 of those are contracted, in this case it's holding tanks, how do we arrive at a cost? I'm assuming you mean how do we arrive at an appraised value? Because you would, let's use fake numbers. Let's say that those 300 you said 2,000 holding tanks generate $100,000 in revenue consistently. That revenue I know can be counted on for your next buyer to be able to pay for the business. So I would just weight that revenue higher than the other. Let's say the remaining revenue was another $400,000 to make it an even $500,000. I would put more value on that $100,000 of contracted work. And when I get into appraising, actual appraisal values, I'll kind of point that out to you. But I just weight it more heavily. I can't tell you that I put $100,000 on the bottom line. I just know in the back of my mind that 1/3 of the work is going to be guaranteed perpetually. Does that make sense? Anyone else have any questions on other things we've done so far? We'll move on. Businesses with greater tenure are worth more. It's obvious. If you're the only show in town and you've been in business 40 years, everyone knows to call AAA Pumping. Everyone knows to call Chain of Lake Septic. Everyone knows to call Harvey. He's the guy that does it. Tenure adds a lot to value. Usually, you've got a larger customer list. Usually, that type of equipment is better maintained and newer because they've got more money to put into new equipment. These are all stereotypes and generalizations, but generally speaking, tenured businesses are worth more. It only makes sense. Yeah, that was a comment more than a question, but you're exactly right, and that's where I said the comment was, in a larger metropolitan area, people are more likely to price shop, and in a smaller town, you're more loyal because you probably know the person who's doing the work. And that's right, and that's why I said there are benefits to being in a smaller town, and the profit levels are probably the same because you're going to have higher expenses, you've got more price shopping, there's loyalty involved. The thing between geography is more, it's just that there's usually longer runs between service. There's definitely pros and cons of both. She's asking basically how do you appraise the database of customers? You're not putting a value on the database, and again, I'm going to get very specific, more specific on how we appraise. If you have no database, I'll probably deduct 5%, and you'll see the percentages here in a minute. If you have no database, I would deduct 5% right off the top of what I'm going to value your gross at. If you have a mediocre database, I'm going to value it based on an equation I'm going to show you. If your database is awesome, and it's very well maintained, and it's all current customers, and many of them are contracted, I'm going to probably bump you up 5% in my valuation. And we're right around the corner from showing you that. Here we go. And we're talking about a customer list. Oh, I'm going backwards. Whew. It's my first time. Sorry. Here's the magic formula that we use. There's a lot of formulas out there. Most people are used to hearing an EBITDA formula, an earnings before income tax and depreciation. There's also a seller's discretionary income formulation. I use what I call a whole set value of assets plus a portion of your gross profit. I'm sorry, a portion of your gross revenue. So my valuation can range anywhere from, quite honestly, 0% of your gross revenue up to 50% of your gross revenue. And things we already talked about are how we determine that. The first thing you're going to do is I'm going to take a list of all of your equipment that has wheels on it. Anything that has an engine or wheels. I don't care about your computers. I don't care about your desks. I don't care about your file cabinets. I don't care about your toilet paper. I don't care about your hoses. I want to know what's got an engine or wheels. Okay, and I'm going to take that equipment and I'm going to do my best to appraise it at a wholesale level. That means if I were to bring it to a Ritchie Brothers auction, what could I expect it to sell for? I'm going to take that value and I'm going to take it as one whole number. Let's say, just for ease of talking, that value is $100,000. I've got your equipment valued at $100,000. I'm now going to take a portion of your gross revenue. And depending on what you're doing right or wrong, that value can be anywhere from 0 to 50%. If you're doing everything right, the highest I've ever valued a business would be 50% of their gross revenue. If you're doing everything wrong, you might as well just sell your equipment because you're not selling a business, you're selling your job. The minimum ROI that okay, now we're going to get into something that's a little bit more difficult. What I'm going to call a big company is a company that grosses more than $2 to $3 million in revenue. I'm going to call a small company anything that grosses less than $2 million in revenue. Anybody who's out to buy a big company grossing more than $2 million in revenue is going to want to see a 35 to 45% return on investment. And you all may be gasping and thinking that's a crazy return on investment, but that's the fact of the matter today. That was different 5 years ago, and it might be different 5 years from now, but that's the ROI they're going to want today. On a small company, that ROI has to be at least 25%, or it's not going to make sense, and I'll show you why. Here's an example. We've got a $200,000 equipment value. We have an annual gross revenue of $1 million. Like I discussed, you've got 50% of your contracts, or 50% of your customers are contracted. All of your equipment is in new condition. You're taking an owner's draw. You're showing a profit. You're in a great geographic area. All the stars align. I'm going to take 50% of that $1 million and come up with $500,000. Middle of the road, I would probably put a 40% valuation on it. Your geographic area might not be as good. You don't have that many customers. Maybe you've only been in business for 10 or 15 years, not 40 years. You'd be at a 40%. 25% is just kind of, you're doing everything right. Your equipment might not be all brand new, but you've got decent equipment. I'm at that 25% valuation. Worst case, 15%. Basket case is 0%. That's, again, you just got a job. So now we're using the best case valuation. You have the $200,000 value of equipment. You've got $500,000, which is 50% of revenue. My asking price for your business is $700,000. If I'm asking $700,000 and we're assuming a profit of 25%, now that seems like a high profit, but that's, again, you're counting every dollar. Remember that. That's the restaurant money. That's the money for your pickup truck. That's the money that should have been put into profit because you're now thinking about selling. 25% profit margin, $175,000 down payment means you have $525,000. The first thing the new buyer is going to want to do is take a profit of his own, or basically a management salary. So I'm setting it horrifically low at $40,000. That leaves $210,000 because we had a $250,000 profit, remember, to paying off the note. $525,000 at 5% for 5 years means you're paying $120,000. So that leaves a $70,000 profit. Now, I show you the ROI. Your $70,000 profit, less considering we had a manager, which you may not need, means their investment of $175,000, that's a 40% ROI. Your ROI is your profit divided by your investment, and then if you want it as a percentage, it's divided by 100. So when I said you needed a 35 to 45% ROI, you can see that I just priced that business that was doing everything perfectly at $700,000. I showed you reasonable payment terms, and now you can see why I priced it that way. That is the only way you'll sell that business today. If you price it any higher than that, you're not going to get it because the ROI won't be there. If you price it any lower, well, you can price it lower than that. I wouldn't want to. I'm going to go through 2 more examples, but go ahead.
You just jump back once, God bless her, you're going to be a good screwdriver. You said all that with one breath. If you jump back one, why did we take the manager's salary out? What was that again?
When somebody's buying your business, you can't always assume that they're going to want to work it themselves. So if I've got to hire anybody to manage, always assume whoever's going to buy you is probably going to be bigger than you are. So you can either take that manager's salary out and just add it to the bottom line as a profit, or just assume that they're going to have to hire. The question was, why did I take out the manager's salary? And the answer is because they may not want to run it themselves. And in most situations, they don't. So you don't have to do that. You could have just added that to the bottom line, and that would have shown this that profit, instead of being $70,000, that would have shown up as $110, and it would have showed a much higher ROI. Although I would argue if you put that 40 back in, I'll bet you it's pretty close to 45.
Which makes a significant difference.
It does. And you know, you realize when you put an asking price on a business, and what I just showed you was a best case a best case asking price of $700,000. And I'm going to get into some things about how close you're going to get to an asking price and things like that. We're pricing this at the 40% ROI, okay? You don't get asking price ever. It's like buying a house or buying a car, okay? That's the MSRP. So you're going to get less than $700,000. But the way it's priced now, to the person who comes in, they're going to look at it and say, okay, the way it's priced now with what they're showing me, with the supporting paperwork they're giving me, I can get that 45% ROI that I was hoping to get. Does that make sense? Yeah. I'm sorry for talking fast on one breath. I'm going to try to breathe now. Where was I? I blew it. Yeah, it's that one, okay. And then we just did, we did that one, we did that one. Okay, now we're just going to use a $600,000 valuation. Just to give you the 600 valuation, whoop, where'd it go? That would be, the $600,000 valuation would be, your equipment cost never changes. The value is, it is what it is. I appraise it wholesale value. So $200,000, but now let's say those other somewhat more intangible things you're not doing quite so right as the guy that does everything perfectly. So now I've got your $400,000 plus your $200,000. I'm going to show you a $600,000 valuation. Whoop. Same deal. We're asking $600,000. Your profit level is obviously lower. That's why we're asking less. So you've got a 20% profit level where the other guy had a 25% profit level. $150,000 down payment because it's still 25% of that asking price. Set aside that same manager's salary, $160,000 toward the note. The note is smaller because you're asking less. You've got $102,000 now that you'd have to put toward paying for that business. Leaves you a $58,000 profit, which magically falls into a 40% ROI, just like the last one did. Okay? Again, we haven't negotiated the price of the business. That's what the buyer's going to want to see, that 40% magical ROI on paper, and then you start negotiating. So now you can see where the profit level was smaller. You weren't making 25% profit, you were making 20% profit. I adjusted the price accordingly, but the math all still works out in the end for the potential buyer, and if the math doesn't work for the buyer, you're never going to sell it. Go for it.
Years and 5 years is a norm for paying a business off?
Yep.
Is this standard?
That is the norm, and I'll get to that in a second. I'm going to talk about owner financing and financing in general. If you can go through a bank or a small business loan, you might be blessed with a 15-year note, but in today's banking system, if anybody in here can get a note from a bank to buy a business, I want to talk to you when you're done, because I've had a half dozen businesses fall through this year that we could not get financing for. So we're going to get to owner financing, and you're making me jump on it a little bit early, but if you're not willing to owner finance, you're probably not going to sell your business. And at least when I advise someone, I always advise not longer than a 5-year term if you're owner financing. So that's why I'm using 5. I'm considering owner financing in all of these examples. And I'll expand on that in a little bit. What am I at for time?
5%? That's extremely high.
I don't think so. I advise anywhere between 5 and 7.
Bank could go 6 or 7 if they were lending. If
they were lending, exactly. If you can go get a note from a bank, I would advise you to go get it. I'm advising my sellers to take a minimum of 5%. And I don't think that's unfair. 7% is more where we shoot for. The last, a $450,000 valuation. The 450 valuation is going to be, this is almost where I end up with, I would argue more than half of the businesses that I appraise end up in lowercase, I shouldn't have said lowercase, I should have said average case. The great majority of businesses I appraise end up right here. 25% valuation of gross plus the cost of equipment. That's average right there, 25%. I'm going to show you the valuation on that one right now. So your asking price would be $250 plus 200 equals $450,000. The $450,000 valuation. You've got your asking price, the down payment of 25% equals $337,000 left over. Same manager salary, again, that's meager in my opinion. $110,000 left to go toward paying off the business they just bought from you. $337,500, $77,000 per year in payments, you've got $42,000 left in profit, significantly less, because they were only operating at a 15% margin. So you've got $42,000 left in profit. Our asking price, however, has gone down to $450,000. The return on investment, 37%. So you should be able to see now that however much profit you're showing has a direct impact on how much we can ask for it, but the ROI for the potential buyer stays exactly the same, 37 to 40%. We were in there the whole time, and there's been no negotiation yet. So that ROI could increase or decrease. I think, was that my worst case scenario? Yes. The last scenario, whoops, yeah, that's it. The last scenario is that 15% scenario. There are a fair number of businesses that fall into this category, and what I'm about to show you. If you fall under a 15% valuation on your gross, I don't think you would find a broker to represent it, and I'll show you why. Because what you're essentially doing there is you're not selling a business anymore, you're just selling the job that you've had for however many years you've run it. If I'm asking $350,000, I'm assuming a profit of $100,000, that's 10% of gross. $87,500 down payment leaves this. Manager salary, $40,000. Here we are. We got $60,000 in payments because we took out the owner's salary. We had $100,000 gross. Remember that? Our payments are $60,000. So there's zero profit. None. So what are you selling? You're selling your job at that point. You're not selling your business. You're selling a job. Jobs are in the newspaper. So it gets back to keep good books. If you're not keeping your books, you have no value in your business. None. You're selling your job. So that guy just bought a $40,000 a year job. There is a but. There's always a but. In 5 years, he'd be making $100,000. Okay, he bought a business now. That isn't where I think most people who want to work for themselves want to be, but that's where I'm just trying to push, learn your valuations. Here's where we kind of got onto this now. There is no money. Banks aren't loaning money for businesses. There are still SBA loans out there. There's a lot of paperwork. We can all see they're scaling back. I haven't seen one get approved yet this year for any businesses that we've represented. Right now, the only way you're probably going to sell your business is through owner financing. Everyone understands that owner financing carries greater risk, and that's true. But it also carries greater reward. We just talked about a 5% return. We negotiated a price based on an ROI, but if you can carry that risk yourself at a 5% return, you're making the interest off that money now as well. And that's kind of the reward from it. There's also ways to kind of leverage the risk. You can enter agreements where you can get your prospective buyer's personal property as collateral. That is legal. If they own a house, if they own a car, if they own property. The other thing you can do, the other thing I would advise doing is the first thing you do is ask them to provide a term life policy on themselves in the amount they owe you. Because if that person should die in the middle of paying for your business, chances are you're not going to get paid. But you would be named the beneficiary of that life policy, and you immediately get paid. That way, if the business looks like it's going down the tubes, you can put a hit out on them. There's other things to do as far as just, in my opinion, one of the best things you can do is offer owner financing for one reason. That means that you're so comfortable with your business that you know they're going to be able to make the payments. And when someone comes to me and I explain it that way, it's like the light goes on and they say, yeah, you can go to the seller and say, hey, this guy's willing to offer owner financing because he believes in this business. He or she has probably run it for 20, 30, 40 years. They know what their bottom line is. It should be documented in black and white on a balance sheet or a profit and loss statement or whatever. But by you saying I'm willing to owner finance this business, it's really you putting your stamp of approval saying, I'm comfortable selling this to you because I know I've supported my family for 30 or 40 or 50 years doing this. So when you think of it that way, it's not a horrible thing to owner finance. The bulk of the responsibility falls back to you if it should default, but there are ways to to kind of counteract that, to get some things on paper, a life insurance policy, some assets, but be prepared to owner finance, and in the end, you'd be better off. There's significant tax savings in owner financing. There's just a lot of good reasons to owner finance with all the bad ones, and most people just worry about the bad ones. But be prepared to owner finance if you're planning on selling in this day and age. Does anyone have any owner financing questions, since I glossed over them before? Well, you're just not showing. The question is, why is it going to be better? I'm no accountant, first of all. The question was, why is it going to be better for me to not show the huge upfront, say $700,000 on 1 year's taxes? You're moving into a different tax bracket, number one. Number two, there's probably different capital gains if there's real estate involved that you might be able to amortize. You could lease back shop equipment. You could lease back property. Just to amortize it over 5 years, there are going to be tax savings. You would want to get with your accountant, but any accountant will tell you there are tax savings when you owner finance because you're going to be amortizing $700,000 over 5 years rather than taking it all as one lump sum. I'm not an accountant, but that's the general part of it. You do. You have to percentage off what's goodwill and what's not. I mean, it's a tax question. The question was, you have to proportion certain things to goodwill and equipment. And you're going to get taxed at a higher rate on the goodwill portion, which is the profit portion, unfortunately. And I don't know the legalities of, let's say we had that down payment of 25%. They're usually going to make you say, okay, well, the down payment, 25% of that went toward. They're going to purport, the IRS is going to look at it. Your accountant is going to have to say a portion of the down payment was goodwill, a portion of it was for equipment, and they're going to do whatever's within the law to make that work for you. But if you take that whole chunk at one time, I guarantee you that you are paying more to the government than if you take it out over 5 years. I don't know if everyone heard that, but he was just basically saying that if you amortize the cost of the business over 5 years and you take that now as your income or a salary, or just report that as your income, I guess would be a better way to put it, is that income you're reporting could now potentially have been less than you were reporting before, so that would move you around tax-wise. It is more beneficial, and there's a million reasons for it. So much of this gets personal, and I don't want to get personal with people because it depends on what tax bracket you're in. It depends on, sometimes it may not be legal to, say you were real asset heavy, say that you sold a business for $500,000 and $400,000 of that value were assets, you may not be able to report that as income. See, every business is different, so your scenario may or may not work. But you're right on the money as far as if it works out right, you want to report that annually as income. That's the gist of it, yes. The question is, how do you know your potential buyer is good for the money? You don't. If you're working with a broker, you can, even if you're not working with a broker, you can request 3 years financials. Doesn't mean you're going to get them, but you can request them. You can request collateral. Again, that's the biggest one I always shoot for. And you can request personal collateral. And if you request personal collateral, you have to have a spouse and a husband and a wife's signature, both. Because if you only get one, they can transfer collateral. So there's a little tidbit for everyone. There's certain things you have to do to cover yourself, but the general question is, or the general answer is you don't know. I mean, you're not working with a bank where the bank takes on the burden. You're expecting them to pay for it. In any owner financing deal, the business falls back to you, but if you've got a bunch of junk after you sell it to them because they've run it into the ground and all your customers have gone away because they provide poor service, yeah, there's a risk. We talked about there is a risk, but there is a reward.
As an owner finance, do you have any control over that contractually, maybe?
There's a way you can control it contractually, and it's kind of a different topic that I wasn't going to touch on today. What you do is you set yourself up as a corporation and you make yourself the board of directors.
It's already a corporation.
Okay? You're the board of directors of that corporation until it's paid in full. Now, when you're the board of directors of that corporation until it's paid in full, you can make decisions on management. You can decide which vendors get paid first. So that would help you alleviate some of that risk. Because now when you're the board of directors of your own corporation that you don't even own anymore, if I were you and everything's going right, you better damn sure keep hands off. But if everything starts to go wrong, you better damn sure get hands on in a hurry. But the first thing you can do is say, current management is gone, I'm running it again. You're not paying me, I'm running it again, you're done. And you are legally able to do that because you're the corporate shareholder. So that's one way to get around that I wasn't going to touch on.
Kind of bearing in mind all those questions, but the other take is if you're a potential, if you're a buyer and you come in with money and you don't need owner's financing, what kind of leverage do you have working with that? No?
We're going to get to that. Shoot. We're going to get to that, and you have much greater leverage because we're going to talk about how well you can negotiate based on if you have to owner finance or you don't. If you're a cash buyer or a buyer with bank financing behind you, you have much more leverage in negotiating a better price. That's the answer. The question was, do I have considerably more people coming to me trying to sell their business than I do buying? Yes and no. I have far more sellers coming to me than I have qualified buyers. Does that make sense? Anything else? We've got a few minutes left here, and then we'll open it up for, oh, I'm sorry.
I have a question. If you're maybe on the board of directors and, you know, like you said, if they default on taxes in any way, how responsible would you be for those taxes if they default on it?
That's a good question. And I am actually going to get to that too when I say you need 3 professionals to help you, and one of those is going to be an attorney, which I'm also not. Inexperienced buyers will pay more than experienced buyers, and that goes for both industry experience and buying experience. If you're a septic pumper and you're looking at buying a septic pumping business, I guarantee you they know more what your business is worth than somebody who's coming in from outside the field. And we do get buyers from outside the field on occasion that don't, they're going to value your business. They might be willing to pay more for your business because they aren't going to understand the books as well, the things that go into it as well. They'll pay more than an experienced buyer. People who have bought before, they're better negotiators. They probably have more means to buy. Experience goes a long way. You're probably going to get someone, you probably won't get as much if someone is coming in with experience, unfortunately. You will need 3 wise men or women to help you. An accountant, a broker, and an attorney, in no particular order. An accountant understands the tax implications in advance of selling, both personal and professional. So when you're no longer incorporated or no longer doing things as a business, they can say, hey, from a personal standpoint, if you're just going to file a personal return, you might want to do this, or you may want to stay incorporated or an LLC for this reason, whatever. Talk to an accountant. You're going to want a broker for several reasons. Less than 5% of the people who ask about a business will develop into a serious buyer. That means for every 100 phone calls you might get on a business, 5 of those might be legit. If you're prepared to take those calls, list it yourself. If confidentiality is important, again, we require a non-disclosure agreement on everybody that calls and asks questions on a business kind of beyond just what is it, where is it? Depending on what type of relationship we have with the seller, sometimes we won't even give out the city it's located in. We'll just do a geographic area. But we require a non-disclosure on all of that. If you can't determine the difference between a qualified and a non-qualified buyer with 3 questions on the phone, you might want to consider going to a broker. It's definitely possible to sell the business on yourself. And in fact, the first thing I tell everyone when they call us is I said, did you call your competitor yet? Because chances are he's going to be your best bet to buy it. And you can make that call. If you don't want to make that call, you can certainly hand it to a broker and they can make that call as well. But your competitor is probably going to be the first person that's going to look at it. So you can sell it yourself. It is possible, but a broker does a lot for you. An attorney. Letters of interests are going to be drawn up, offers to purchase, answering questions like if you're to maintain yourself as a board of directors, what happens if a tax isn't paid? Things like that. Non-compete agreements, which are also usually part of selling a business like we're doing, septic, portables, drain cleaning. You can almost bank on probably minimum of a year's non-compete, probably more like 2 or 3 year non-compete. So that's part of what the attorney would write up. And then I guess this is just last in closing. That last example I made should have hit home for a lot of people who aren't counting every dollar that they make in revenue. If you're at a 10% margin, using the numbers I used, and it's not always a 10% margin because a 10% margin on 10 million is certainly different than a 10% margin on 100,000. But if you're operating at a margin that doesn't allow you to draw an owner's salary and still have money left over, you're not selling your business, you're selling your job. And I have, let me think how many buyers I have for jobs right now. None. I don't have one buyer that's looking to buy a job right now. So that's, in a nutshell, is the buying and selling of a septic business or a sewer business or a portables business. If anyone has any questions, we still have about 10 minutes left. I'd be happy to answer them. Otherwise, I'm here for the whole week.
Percentage-wise, how many people, maybe prospective buyers, do you have that are looking for portable sanitation companies, and how many are for septic companies, yada yada?
Percentage-wise, she asked how many are looking for portables, how many are looking for septic, how many are looking for drain cleaning. I would say I have more looking for drain cleaning and septic right now, and for those of you who are in portables, it's probably an obvious reason. The portables market right now is probably the slowest. Yeah, it's saturated, it's price cutting, it's, there's people who have 5,000 toilets and 1,000 of them are sitting in a yard. The profit margins and gross margins are down in that industry in almost every geographic region I've appraised in the last year. So right now, there aren't a whole lot of people out there, unless what you're doing is a fire sale or an asset sale, there aren't a whole lot of buyers out there for restrooms. With that said, I have appraised a half dozen or so businesses this year that have done really well in the portables. But the septic businesses on a whole have remained constant over the last 3 years, as have sewer, drain, and plumbing. Ma'am in the white.
When you were talking about the broker, were you talking about your common real estate broker? On your local level?
When I talk about a broker, I talk about a broker on any level. If you've got a substantial portion of your business is real estate and you do want to sell that as part of it, I often tell people to go to their local real estate broker, just because if the greatest value there is real estate, I live in Wisconsin. I can tell you what stuff is worth in northern Wisconsin, but I can't tell you what it's worth anywhere else. So yes, I'm talking about a local real estate broker. If you're just talking about selling your business, I would say go to any type of business broker. And there's a lot of them out there. Really just what it comes down to is what's their industry experience and what's their commission. A really good broker is probably going to charge you around 10%. I'm really good and I charge half that. Thank you for laughing. But a really good broker will probably charge you 10%. We do charge 5, 6 depending on the asking price. But I would go with a business broker if there's no real estate involved. I would go with a real estate broker if there's a substantial portion of real estate involved. Well, that's pretty standard right now. The comment was that a bank will only loan on what they know, what's in black and white right now, not what you can...
Not what you can do.
Right, not a forecast into the future. The question was, if you do installs and dirt work, is that an asset or a liability? Does it profit? Is the answer. I mean, obviously the assets have value. You're going to have excavators, and you're going to have dump trucks, and you're going to have lowboy trailers, and you're going to have, you know, all that stuff. That has that wholesale value. Now, if you can take that portion of the business and separate it out and say, well, I know when I dig, I gross X dollars. Yeah, it definitely has value. But if you're just basically breaking even because you're digging because you want the service work later, you know, and it's kind of feeding off the other, it may not have value by itself, but I would say it still has value as a whole.
There's no customer list really based on...
No, yeah. If you were just an excavating business, I mean, that would be a lot tougher. I would think I'd probably value you lower in that, you know, 15, 25, maybe 30% range, just because, again, no contracted work. I want to talk to you when we're done, because I want you to explain to me what you're talking about. Anyone else?
Yeah, how do you protect yourself?
The question was, how do you protect yourself if people are buying based on the name, and when the name is gone, that the business might go with it? Well, do good work is part of it, but I mean, sometimes you can't protect yourself. I mean, to me, that comes back to the small, you know, we talked about how big is a big business, and I said 50,000 or more. You get into those really small towns, and to me, that's when that comes into play, because I know you personally, and that may be why I call you. I guess if that buyer doesn't have the same charisma and personality and business know-how as the person who sold it, you may not be able to protect yourself. It's tough. You're gambling. That would be an owner financing gamble to me. If you felt the person you were selling it to was a complete dolt, I would back away from that sale. Just based on that alone, if you were in a small area. Question was, what do you want to make your owner's salary? It doesn't matter. That's to the bottom line to an educated buyer, and the broker would present it the same way. It would say, this is discretionary income. Whether you want to use that to pay off the business or draw as a salary, it really doesn't matter. So make that, if you're showing $10,000 profit, but you're taking $1 million owner's salary, you're still at $1,010,000 that can go toward paying off the business or to use toward whatever you need.
Right, that's what I was getting at. Which way was better to go? That's what I was wondering.
It does. It makes no difference.
They're the same.
They're exactly the same. The question is, does a franchise name have a different valuation than a non-franchise? It still comes down to dollars and cents. I don't care if you're a Mr. Rooter, Roto Rooter, whatever you are. If you're not making a profit, your franchise has no value either. But if you're in a very good protected territory and you're making a great profit, I would probably bump your valuation up a little bit for that, because you've got national advertising behind you and things like that. The question was, how do I come up with that gross formula? I take a 3-year average gross. So if you did 200, 300, 400, your average would be 300,000 gross over the past 3 years, and I would take that valuation based on a 3-year average gross. Is that it? Thank you, everybody. Enjoy the rest of the show.